Hi, it's Lee and welcome to the Tesla Economist. I was recently talking about how the Highland update could actually do more to Tesla's financials than the Cybertruck. And when I said Highland, I was also including the Model Y equivalent update known as Juniper. There are rumours circulating around that the Highland could reduce costs by as much as 20%. That's obviously a massive number and does an insane amount for Tesla's profitability. Just to give you an example using some indicative numbers, if the Model 3 ASP is around $42,000 with 18% margin, then that comes to $34,400 cost of goods sold per Model 3. Now, if we remove 20% of that cost, it takes it down to $27,500. I repeat, $27,000 to make a great looking electric car, and that's in the US. Presumably, we would see a similar saving in costs in Shanghai, which would mean the cost of that car is likely below $25,000. Anyway, 20% saving in cost is approximately $7,000 for 3 months Model 3, at least within that ballpark. Now, a lot of investors think Highland will save over $5,000 in production, so this is in line with that. It is not out of the question to think there is a possibility that Tesla will be using castings for the Model 3, which obviously saves a lot of parts and processes. Incidentally, that would take Model 3 margins to a ridiculous 35%, just saving 20% in cost. I mean, isn't that absolutely crazy? But is this really possible? Well, bear in mind, Tesla are basically using the same manufacturing process that they were using in Fremont in 2017. Not much has changed since. The car is very similar, and like I said, not even using rear castings. Think how much Tesla have learned in manufacturing since 2017, and how many millions of electric vehicles they've made since, and what they must have learned. Along with the market too, and what customers want. Tesla initially launched the Model 3, or the Model S too really, with really high specifications, absolutely destroying all internal combustion cars on paper when it came to acceleration and running costs. Tesla liked showing off just how fast the acceleration was, and it may have been necessary to show the benefits of electric cars at the time. However, we consumers got the message, or those who needed it, but now we've moved on, and affordability is much more important than being able to drag off a Porsche at the lights. So Tesla started using lower cost motors that weren't as quick but cost less. The performance had negligible difference for most drivers and wouldn't notice. But they certainly will notice a lower price tag. And Tesla are able to now reduce some of the cost by lowering the specifications in some areas that matter least to the consumer. That is now in line with the new price points. Of course, it was different when Teslas were a more premium price. I mean, this all makes perfect sense. Reduce the specifications to match the price in order to leave some profit. And Tesla are still offering far more than any of the competition, or so-called competition, aside from what could arguably be a more dated design due to the Model 3 being 6 years old. Well, of course, we have a new Model 3 design on the way too. No, it's not a total redesign like most auto manufacturers do on a continual basis. Tesla is keeping the core shape of the car, which will maintain economies of scale. There isn't really anything wrong with the overall shape of the car. It tends to be lights that age a car most, and that is the most notable changes that we can see here. And from the pictures we have seen, it does make a difference. I think it looks great, and I think it will stimulate demand just from the looks. But the specifications are even more interesting, as the other major rumour we're hearing is that it will have a 66 kilowatt hour battery, and there are reasons to believe this with CATL's new batteries and battery factory. Although a lot of people keep saying that this is an LMFP battery, which isn't entirely true. It's a hybrid LFP cathode with a ternary cathode that contains manganese, which isn't quite the same, but is still a step closer. Supposedly 10% more energy dense, thus going from 60 kilowatt hours to 66 kilowatt hours. Now, in my opinion, if this is the case, it is a really big deal. Something that is totally underrated and not close to valued into the stock price. Then the fact that Tesla could be saving 20%, yet offering a Model 3 standard range that is now offering over 300 miles of range EPA. Well, I think that if Tesla have a new design with more range, then the demand will increase and thus the price will rise accordingly. Whenever demand increases, Tesla match the new supply and demand with a new market clearing price. Legacy autos do this too, except more so at the dealer level. A 300-mile plus range vehicle is going to be very popular. So if Tesla increased the price accordingly, then the margins for the Model 3 could be huge. Personally, I think it might be a little bit too good to be true that Tesla managed to save 20% cost on the Model 3. That is a big number, even with the inclusion of gigacastings and structural battery packs. If that was the case, then I'm sure Tesla would have done that a long time ago. Unless perhaps the waiting list for gigapresses is that long, but I think somehow Tesla would have managed. What is interesting though is that the Model Y factory is smaller than the Model 3 factory in Shanghai, yet the Model Y output is significantly higher. So there is a possibility that Model 3 supply could increase quite a bit. This would mean further economies of scale due to the same factory producing perhaps 50% more vehicles. Then there'd also be the need for the demand for those additional vehicles too, which might be absorbed by the new demand for the new design, and potentially Tesla can lower prices slightly too due to these cost savings. I mean, imagine a Model 3 starting in the US at $39,000 that has over 300 miles of range. Of course, this is most likely knocked down to $31,500 after the tax credit, which will become a subsidy next year, not to mention all the other incentives from various states. It really is mind-blowing how there is not a longer waiting list on these cars currently. What are people waiting for to get an EV? Anyway, if we keep wondering that, we'll go back to talking about how Tesla should be investing heavily into advertising. And then if Tesla are doing Model 3 castings in Fremont too, then that would reduce the required floor space for production and mean Tesla can produce more Model 3s in the same area and thus further economies of scale. Then we have something similar to potentially look forward to for the Model Y, the equivalent update. Now, the Model Y, kind of being the best-selling vehicle in many markets or potentially globally, is now 4 years old too, but was mainly derived from the 6-year-old Model 3 design. Well, it could also do with a similar update and is obviously on the cards. The rumours are for early next year, but if it can also push for a larger battery, giving that slightly higher range, then that is going to do absolute wonders for demand. The old Model Y standard range that used to be sold in the US was 244 miles, with a 2170 battery at the time. Elon pulled this version as he thought it was insufficient range for the market, and the current rear-wheel drive gets similar range. But if a slightly larger battery can push this up to 270 or 280 miles of range, that's going to have a huge impact on demand for that car too. Not only that, it might also mean that Tesla will start to offer the rear-wheel drive version in the US again, which, if I had to guess, might cost around $44,000 and have similar range to the 4680 all-wheel drive version. There would obviously be a ton of demand for this vehicle, and the margins should be good too. It might mean a re-altering of factories, and perhaps Fremont just makes these rear-wheel drive Model 3 and Ys, and a long-range and performance Model 3, and then Texas just makes the all-wheel drive versions of the Model Y. Anyway, I think we more likely see something like $3,000 cost savings for the Model 3, which is actually less than 10%. However, I think there'll be an increase in demand, which may increase prices somewhat. I hope I'm being conservative here, but I'm trying to be realistic and removing hope from the equation, as I truly attempt to be as objective as possible. Therefore, if this Highland update is going to have the specs that are rumoured, then I believe it could increase the discrepancy of costs and price by 10%. Let's say it will reduce costs by $2,500 and increase prices by $1,500. And if we take current ASP of a rear-wheel drive Model 3 at $41,000 and 18% margin, then that would take the margin all the way to 27%. That is insane to think we could see these sorts of margins again, but perhaps you might think that is too extreme. Well, just another example is if we reduced costs by $1,500 per vehicle and increased prices by only $500, then we're still hitting 23% margins. Then perhaps we might expect something similar again with a Model Y update, and with the quantity we should be hitting around then, hopefully something like 500,000 units a quarter by early next year, if we're able to reach 23% margins, and that's going to look really good when it comes to operating margins. And I'll go over these finances in more detail with that. The downside is we probably won't know these numbers because Cybertruck will be out and reducing margins, as the capex for Cybertruck will go into COGS. Anyway, let me know your thoughts on how much impact you think these updates might have on margins too. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.